So first, let's have a look why Nvidia had this astronomical increase of stock price. So pretty much from we can see from the year 2000 till until this day there was a 1000 times fold increase, and in linear chart it's just pretty much to the moon. Like it's just the stock price looks ridiculous. So if we zoom into the logarithmic chart, we can see the stock price. It actually makes more sense because it's also in correlation with the revenues of the company. So actually it's not that much of a surprise that in the end the stock price did what it has been doing, because the revenues are in correspondence to the stock price. So if we look at the price chart, then it would have been quite a good time to get into the stock in 2003, just after the dot-com crash, because even though the revenues didn't change that much, the stock was very overpriced, as most of the technology stocks at the dot-com boom, and then it was trading at a discount. Like we can see 2004, 2003 price to sales was about 3.56, and even on one quarter it was less than 3. And before that, investors priced at the height of the boom, the investors priced stock up to 30 price to sales. And so what I did here was I calculated the mean. So the mean is not the moving average. The mean is calculated until that quarter. Like it's not lagging indicator or anything. Until this point, whatever point you see in this chart, this is the mean. So now all-time mean for Nvidia is 23. But as you can see, like until 2015, it was quite a good point to enter, because it was still trading significantly under the all-time average. And now I don't think like it does really make sense to even focus on getting into the stock, because as you can see, since 2017 the price to sales has been like sky high. So what we want to do is we want to find fast growing companies like Nvidia, but they with relatively small market cap. And so we're trying to replicate the metrics that Nvidia had in early 2000s or even later. But we try to find the same kind of companies now. So it might make sense to like pick a date, let's say 2003, or let's say some report in 2003, and because this is where you could they did get the best returns, and this is where the company was most undervalued, even though the revenues were getting higher. So we gonna see what Nvidia did in terms of book value and revenues. So there was some discrepancy. The market cap did not reflect the exact book value and revenue change. So as we can see, the Nvidia revenues had a peak in 2002, like with a correlation with the dot-com boom, and it had a significant revenue drop for a few consecutive quarters. But we should have to bear in mind that it also had a huge, like unnatural increase, and the stock was very like underpriced in 2003. But we have to have a look that the revenues were still bigger than even though there was a huge dip in 2003, 2002 from the top, and the price, the stock price acted accordingly. It was still quite a lot higher, like a lot higher since 2001. 2001 revenues. So what we want to check is today's revenues higher than the maximum of 1.5 years ago. So this is what we are looking for in the companies we will try to replicate. Is not that we don't really care about 1 year change or 1 quarter revenue change or net income change. If it is still higher than the maximum of let's say what it was 2 years ago. So therefore this is something that we will put in the algorithm. I also developed a metric that shows how many quarters have been how many consecutive quarters the revenue has had a positive increase. And so we can see until 2002 April the percentage, the ratio is 100%. And even so, if you look deeper into the dip, still at the bottom, when we had this slump of in revenues, still at the bottom, the ratio was 82%, showing strong and stable revenue growth, regardless the dip. Because if you have a look here, the path of revenue increase follows a very organic trend, and this is a logarithmic chart. And now if you have a look at the compounded annual growth rate of revenues, at the dip it was 100%, and at the bottom of the dip it was still 50, which is abnormally good. So we should just completely ignore the dip for the previously mentioned reasons. So let's have a look of the book value of the company. So we can see that Nvidia has had a very stable increase, obviously last 25 years. But now if you look at the dot-com boom and the dip, we can actually see that there was not really any decrease in the book value. So there was pretty much only one quarter that we saw book value. So even though the revenues decreased, but they managed to get the book value higher and higher and higher. So pretty much showing how much undervalued the company really was. Now let's see the metrics of that dip we saw after the dot-com boom. What kind of metrics did Nvidia have? And let's try to find the same matches now. So compounded annual growth rate 54, revenues in quarters that revenues increased 88%, price to sales comparing to the mean 0.39. So book value increased until that point 94%, and price to book mean 24%, so trading 4 times lower than the book value mean, and preferably try to find companies that are young. So maybe because 54 compounded annual growth rate is very high, we try to be more conservative and choose over 30. Revenues increase percentage 80%. So then we don't really care about last year or last quarter revenue change as long as it's bigger than the max of last 1.5 years. And we want to replicate Nvidia to make sure that the book value has been increasing 80% of the time. And then let's look at the young companies. But so what we want to see is do these vectors, revenue vector and book value change, can we predict the future revenue growth? And here we compare all companies in my dataset, which has over 400,000 reports, to the filters we just put up, and there is not that big significance in the first year, but 2 years we can see that there's a big increase in the expected expected revenue in 2 years, and 5 years is a huge difference. So historically the median income revenue change has been 38% of every company in the US stock market, but we metrics like that we can hope to see 61% revenue change. And now if we use the same filter, let's have a look of the expected stock price return. And so in the red, this is the average stock market returns. According to my data, it's 6.6. In USA, median of every US company, and we can see that we can expect double the stock price return in 1 year, double in 2 years, and the median of 5-year return of companies like we just looked like Nvidia, even though we put in more conservative filters, is 192, and 75th quantile is here over 3x, over 300%. And even the lowest 25% quantile is a lot over 0, because if you just pick a company randomly, you can see the bottom is way below in the negatives. But if we look into companies with vectors like Nvidia, the risk of loss is hugely decreased. So unfortunately, now the stock, as we quite high with the stock market, the valuations are quite high. It's quite difficult to find this kind of vectors. But I did change to a little bit more conservative filters. Change the revenues compounded annual growth rate to 15, not to 30, and changed a little bit less the others as well. And let's have a look what do we found. So currently we see the output is 9 companies according to filters, and for this video just let's have a look on the first one. So let's just see what happens. So this company pops up. We don't even really care what it is, what does it does. It trades in the name of ticker name OZK, but all we can see is huge and steady revenue growth, especially last 2 quarters. The jump has been incredible, and the company is not that new, but we see annual revenue growth rate is 21%. It's trading it's up here 2014-15. We can see price to earnings 21, 19, 22, 20 in the 20s. Now trade, even though revenues has increased, net income has increased hugely, trading 7.6, giving it price to earnings ratio 7.2, and price to sales discount is 42. The price is 42% only of the mean. And the price to book is also, according to price to book, it's trading very cheaply, only 45% of the average. Here we can see the steady growth of the revenues has had a huge jump. The same goes with book value, steady growth, nothing worrying. And net income, steady growth, few ups and downs, but most important, we see that the revenues growth has been very steady and very steady and quite high. So these are the metrics that are quite similar to Nvidia, especially the discount is huge now. Price to book discount, price to sales discount, and we can see like it's the price to earnings, price to sales and price to earnings has been going sideways, and now it's was it like 7, definitely almost approaching 5. And but we can see it's at the bottom, and we can hope to see it bouncing. So if it's less than 10, then 2x is what we can hope for. So this is price to sales, and price to earnings also is almost hitting 5, and it has been to 20. So there's like even from the mean, it is a huge discount. So 42 from price to sales, and 45 to price to book. Let's have a look how much was it from price to earnings. Just type it in, price to earnings. Price to earnings ratio. And price to earnings was 7.2. So PE. PE discount 25%, 4 times the historical mean. So in conclusion, we see that the vector of revenues, book value, net income are on upward trend and nothing's really showing it going down. And the price, on the other hand, downward trend, PE downward trend, and we can really expect to reverse the trend as this is the bottom, and making this the ticker really something to consider.